Algorithmic trading involves using computer algorithms to automatically execute trading orders based on predefined criteria and strategies. It requires understanding the basics of programming, financial markets, and risk management. When choosing an algorithm, it's important to consider factors such as the type of data, the desired outcome, the complexity of the problem, the available computing resources, and the interpretability of the results. Trading algorithms are computer programs designed to execute trade orders based on a set of predefined rules and conditions. These algorithms are used by traders to automate their trading strategies and execute trades at optimal times and prices. When evaluating algorithms, it is crucial to assess their strengths and weaknesses in order to make informed decisions. Some algorithms may excel at processing large datasets efficiently, while others may be more adept at handling complex calculations. Understanding these strengths and weaknesses is essential for choosing the right algorithm for a specific task. When selecting an algorithm, it is crucial to consider market conditions and volatility to ensure that the algorithm is robust and effective in various situations. Backtesting and forward testing are crucial for assessing the performance and reliability of algorithms before selection. When implementing risk management strategies within chosen algorithms, it is crucial to consider factors such as volatility, market conditions, and potential losses. By integrating robust risk management techniques, it becomes possible to mitigate potential downsides and enhance overall performance. Reviewing performance metrics and monitoring algorithm effectiveness involves analyzing data to assess the impact of algorithms and identify areas for improvement.